Let me start. Awesome. So I want to welcome you all. Thank you all for being here. This presentation is called Maximizing Tax Savings, Proactive Planning for Year End. In this presentation, we share a process trying to share information on what to do to save money on taxes. There's still time, even though we're in December already. There's still time to save money on taxes this year, and obviously we can proactively plan for next year. Just a quick disclaimer, not going to stop too much here, but I just want to let you know that reproduction of this information and recording of this content are expressly prohibited. Only non-commercial uses of this work are permitted. So please make sure you are aware of that. Now, in today's conversation, we're going to break down what it actually looks like to start a mid-year tax review. And we call it mid-year, even though we're at the end of the year, because tax year or fiscal year works a little differently. We will touch a little more on that later, but we call it mid-year review. We'll walk through three main pieces. First, how to get started, what a mid-year tax check-in is, why it matters, and how it can help you avoid surprises at the end of the year. Second, what information you'll need to gather and review. We'll look at the key documents, numbers, and records you should have in front of you and how each piece connects to your tax liability. Third, we will go over a few strategies you can use now to help reduce or mitigate taxes. Of course, we talk strategies you can use now, and the reason I say now is because, as I was saying before, there's still time to do things to save money for our 2025 taxes. But I want you to take this information, the content, to your future tax planning as well, because these are things that you can keep implementing every year. So we will go over some practical steps you can take before the year ends, like some examples are adjusting estimated taxes, planning major expenses, or reviewing deductions. We will talk about a few tricky deductions or commonly missed deductions that you should be aware of. So by the end, my goal is that you have a clear roadmap that you can use to guide or guide yourself or any business that you manage through the process of tax preparation or tax planning, or just be prepared for tax season in general. So let's start talking about the mid-year review. Many business owners complete a tax check-in sometimes between August to November. I know we're in December, there's still time. Even though that's technically late summer, fall, you'll often hear it called mid-year review. The name isn't really important. The goal is that this review gives you a chance to see where your taxes are headed before the year ends, when most opportunities to change your tax liability disappear. So the reason it's called mid-year review, it's not exactly done at the middle of the year. It's just done before the year ends, because this is when we have an idea of how our finances are looking like, and we still have time to do a few things to mitigate taxes. Why this matters? A mid-year review helps you understand whether you are on track with your taxes. The IRS requires you to pay at least 90% of your current year's taxes in estimated taxes, or 100% of last year's taxes to avoid penalties. If you are behind, this mid-year review will give you time to adjust. Maybe you need to adjust the estimated taxes that you have to pay. Maybe you find out you're on track and you think of ways you can mitigate taxes. We will touch on all on that. But the point is that the mid-year review will give you that picture. Just looking at your numbers before the year ends to see if you're on track on your taxes, if you have to pay more on estimated taxes, or at least will give you an idea on how much you're going to pay at the end of the year. The review includes a few things. You'll take a look at a few key pieces of your business financials. One is revenue, how much money you brought in so far this year. Then we want to know our expenses, what you've spent on the business, same for year to date. Then we will have to calculate the profit. This is easy if you know your revenue and your expenses. Profit is just your revenue minus your expenses. Also, if you are paying estimated taxes, which most S corporations do, you will have to know how much have you paid in taxes paid so far. So your estimated payments or maybe withholding tax to date. From there, you compare this year's numbers you can to last year's. You can compare it. Some people keep it simple and just look at whether they're making more profit than before. That way, they have an idea if they're going to pay more taxes, less taxes. Others go deeper and treat the review almost like a dry run of preparing their taxes. Whatever you do, as long as you have a good idea, a clear picture of how your finances are looking, that's good. That's good enough. So you can do this mirror review as complex as you wanted to do it. For some people, they don't want to deal with that much paperwork. They keep it simple. That's fine as long as they get the important pieces like revenue and expenses. Some people like to almost prepare, like pre-prepare their taxes. So whatever works for you, as long as you have the idea of how your business looking like financially for the year, that will give you a good idea on how much taxes you are paying or how much taxes you potentially will pay. The big takeaway for doing a mid-year review is that a mid-year review will give you clarity about where you stand, and you will still have time to make meaningful decisions before December 31st, which is the last day we can make things to mitigate 2025 taxes. So it's very effective. I really recommend all the most resilient business that we work with. Most of them do some sort of mid-year review, and definitely a very, very good business practice. Before you start your tax review, there are two things that you should do. First, it's recommended that you review your previous year's taxes because this will provide ideas for deductions and other strategies that you can use this year. If you are a sole proprietor, the easiest way to assess your taxes is using um, some a calculator app that I will share with you in the chat. It's available both in English and Spanish. So let me share it with you. This is just a very, very quick calculator. It's more like an assessment tool to know kind of what your taxes are looking like. Second, You will want to collect information on your revenue, expenses, and estimated tax payments. So, what we want to gather, and I'm going to try to be as specific as I can here. For revenue, essentially all the revenue to date from any source, subsidy, family payments, if you receive money from the CACFP, and whatever income you got. Remember those cash payments, those payments from apps like Zelle, Venmo, PayPal. We have to include those. So, however you collect money, if it comes to the business, make sure we include that in when we gather the documentation. Similar for expenses. So all your expenses to date for your business. If you have um, a tracking expense tracking system, then this should be easy if you have tracked your expenses throughout the year. But make sure to include everything: a payroll, rent, mortgage, interest, utilities, supplies, all the expenses that you make in during the year, all the expenses that you made during your year, make sure that you include them as well. For estimated taxes, if you are a sole proprietor, it's likely that maybe you only pay taxes once a year. You can choose to pay quarterly, but if you have an S corporation, they are required to pay taxes quarterly. By law, they have to pay estimated taxes. Also, you have to pay yourself as a salary as a W-2 employee. So your salary is your W-2 income and should have tax withholding included in your payroll. So we have to include those estimated taxes, and we can account also for that withholding tax. Again, if you have a bookkeeping system, this should be easy. So you can likely get most of the information that you need from a profit or loss report. If you don't, no worries. You can still review bank accounts, you can review credit card statements, or any other expense tracking system that you have. Now, for next step, and now that you have gathered all the information, there are two main ways to estimate how much taxes you will pay. Each approach gives you a slightly different level of detail, and both can be helpful depending on your situation. So I will try to explain both, and you take the one that applies better to you. So the first approach is a simple estimate based only on your business profit. This method uses the profit number you calculate, so your revenue minus your expenses, and applies the typical self-employment and income tax rates to give you a rough idea of what you might owe. It's very quick, it's very straightforward, it's very easy to do. So very, very quickly, in 5 minutes after you have your documentation, you can have a good idea of how your tax liability is looking like. We will see an example in a second, but I'm going to explain the second approach, which is a little bit more detailed. I sometimes recommend using a calculator for this, actually, a specific calculator, because it has many factors that we need to take into account. This approach includes not just your business income, but also any W-2 income. If you have a spouse, you have to consider their income too. If you have dependents, what's your filing status, and other personal tax factors that will affect your tax liability. So we call it family income driven because it takes into consideration factors outside of the business, your dependents, your spouse, how do you file taxes, and all that. We're going to walk through both options today so you can see how each one works and decide what approach makes the most sense for you. Let's look at the first approach. Of the two options, doing your review just based on profit is definitely and by far the fastest, but it's a little bit less accurate. It can give you a good estimation, it can give you a good idea, but don't expect um, a specific number or a very exact number from this. But it definitely will give you a good idea. So to do it very easy, step one, we determine your profit. If we already know our revenue and we already know our expenses, then this should be very easy. We have an example on screen just to throw some numbers out there just so you can get an idea. We get the profit. In this case, we got 105,000 in revenue. We have 67,000 in expenses. So our profit is $38,000. Step two, we determine estimated tax. How do we do this? Essentially multiplying the profit times the estimated tax rate. This will be different for everyone depending on how much profit you're making. I'm sure you're familiar with the tax brackets and all that. So that's what it's going to determine your tax rate and how much you will multiply your profit by. In this case, let's assume is 20%. We're in the 20% bracket. So we multiply our profit, which was $38,000, times 20%, we get 7,600. So that's our estimated tax. Now, if we have made estimated tax payments throughout the year, which if you are a corporation, you probably did those quarterly tax payments that you have to make, you can calculate if how much, or you can estimate how much you're going to pay if you still need to pay more quarterly taxes, or if you have paid enough estimated taxes, or if you're going to get a refund. Let's say in this example that throughout the year we have paid $6,000 in estimated taxes. That means we still will have to pay $1,600 for estimated taxes remaining. So that's a very, very easy way to know if you owe taxes, how much you are going to owe, or even if you are getting a refund, if you are overpaying. So that will give you a good idea. Now, for the other approach, and let me go to my next slide here. Perfect. So the other approach, it's the family income driven approach. As I was mentioning before, this approach considers many external factors other than the business profit. Again, we consider a spouse income, withholding tax, W-2 income, if we have dependents. So there are many factors that come into play. Let's do an example here so you can visualize what I'm talking about. The step one is we're going to gather a bit more information. When we talk about gathering information before, we only talk about the business financials, revenue, and expenses. For the family income driven approach, we will need some additional things. So to use this method, you will need, yes, your business numbers, so your revenue and expenses, you will still use them. You will need any W2 income for yourself and or for your spouse. So especially if you're filing jointly. Also, how much tax has already been withheld from paychecks. So if someone's paid from W2 via W2, that means they are probably, when they receive their paycheck, some taxes are already deducted from that paycheck. We want to get how much has been deducted from those W2. Also, we will want to have information about your dependents. If you have children, their ages, and whether they are in school, because this can affect tax liability too. Another thing we want to consider here, if you have mortgage interest and if you have property taxes, you will want to know how much you have paid or how much you expect to pay throughout the year. The idea is that we want to know how much household money is coming in for the whole year and how much tax has already been paid. That's the whole idea of estimating your taxes using the family income driven. Just we want to know how much money the entire household is bringing in and how much taxes the entire household has already paid. For estimating the W2 income for the full year, if you do this review at the middle of the year, we will kind of have to do a little bit of math here. We actually have an example on the screen. I'll mention it very, very quick. The example on the screen assumes that they have received $54,000 from January to June, then and they calculate their withholding tax, which from January to June has been $9,000. So sorry, so they have been their withholding tax has been $12,000. So because June is the sixth month of the year, we can find the monthly average is 54 divided by 6 is 9,000 per month, and the monthly tax withholding 12,000 divided by 6 is 2,000 per month. Of course, these numbers will change depending on when are you doing your mid-year review. If you are doing it right now in December, then you just divide it by 12 months to get your monthly withholding tax, your monthly income. Or actually, you probably could get away with not dividing it by anything because we want to get yearly estimations. So you can just add up everything that you have made in the year. But this depends on what month of the year you are doing your mid-year review. Here, just to keep it simple, we're assuming we made it in June, but you can do it at any moment. Then we want to estimate or full year annual wages or full year withholding tax. In this example, our full year wages will be 100 108,000 and the withholding tax 24,000. That's again just an example. You run your own numbers depending on when you do this review. If you do it in December, you don't have to, you can skip most of these steps because you already have your numbers for the year. You can make a quick estimation on how much left are you going to receive or pay in these 3 weeks that remain of December. But the whole point is that you want to know how much money the household has bring in throughout the year and how much taxes have they paid. So why this matters? Because these numbers will help you determine tax bracket, some eligibility for credits, and how much tax has already been paid. So the estimation will be much more accurate than using the business profit alone. For the step two of the family income driven approach, we want to calculate your estimated tax. And calculating your estimated taxes using your full family income, and I'll be very, very transparent, can get complicated if, especially if you try to do it by hand. Luckily, there are a lot of good online calculators that are very easy to use. You will still need to plug in the information that we just saw, like the income, expenses, how much tax have you paid if you have dependents. So there are many, many very good free calculators online. Just to mention a few, H&R Block has one, TurboTax has one, Get It Back I think has another one. So if you just do a quick Google search of tax calculator, you will find many good ones out there. So once you gather that information, you enter that information in the calculator will instantly give you a result. So I wouldn't recommend doing this by hand. There are too many factors that will come into play. Just use a calculator, and it will be very, very straightforward. As long as you have all the information that I just mentioned, you can finish the whole process in 10-15 minutes, and you will get a good idea of how much taxes you might have to pay or if you're getting a refund. For the step three, we also talk about mitigating taxes. Um, there, the whole point and the main reason of why we are talking about doing this mid-year review or checking your finances before year's end, whenever you want to do this review, the whole point is that you still have time to make things to save money on taxes. That's the whole thing, because if you find out that your profits looking high this year, you probably can get an idea that you are going to have a high tax liability, or maybe you, if you haven't paid enough estimated taxes, you will have to pay a lot at the end of the year. So what can we do to mitigate some of that, of those taxes that you will have to pay? And again, we can only know that we're going to pay more taxes if we do a review. If we don't do this review, we will never know until we get that tax bill. So some things, and this is talking very generally, some things that we can do to mitigate taxes. Because knowing how much you will owe is only one part of the exercise. You also want to identify how you can reduce your tax bill while you have time. Again, this present right now we're in the it's December 2nd. We still have a month. So we have until December 31st to do things if we find out that we are going to owe money on taxes, or if we even want to lower our tax bill. First thing that we like to recommend or mention is contributing to a retirement plan. If you don't already, you can set up a retirement plan for your business. It has many tax advantages because contributions made to a retirement plan on behalf of the business are tax deductible. So you can deduct them for as if they were a business expense. Let's say you contribute a portion of the staff salary, the owner's salary as well. and you contribute a portion of that, you will be able to deduct that as if it was an expense. So the business will pay less taxes. That money at the end of the day will be tax free for you as well. Because if you set up, depending on the retirement plan that you set up for the business, there are many options available. You will be able to get that money at the end tax free. So this is a very, very nice way of saving money on taxes because essentially contributing to retirement plans saves you money in the first place, and second place, it's tax-free money that you are getting. One thing that if you set up a retirement plan for the business, you have to set it up for the owner and employees as well, because this is not a personal retirement plan, this is a retirement plan set up through the business. So that's a way businesses can save a lot of money on taxes. Another thing, and I'm not sure if we have family home daycares here, but if we have, make sure to maximize your home business deduction. Um, I'm not sure again if we have family home daycares here, but maximize the time space, maximize everything that you are claiming for business use of home. So family home daycares can claim a portion of their home expenses in their taxes, like their water bill, their electricity bill, their Wi-Fi, if they pay a repair for their home, those kind of things. We very often see that they are not included in tax returns, but for family home daycares, they are a must include. They will definitely save money on taxes. And I see a comment that we have a home shelter business here. Happy to hear that. So make sure you maximize your home business deduction. That is done through a form called Form 8829. That's essentially where you will include all your business or all your home business expenses. Also, for centers, if we have centers, also you can or you have the opportunity to deduct home office expense. However, the regulations for home office, if your business is outside of the home, are very, very rigorous. So just make sure you do it right. If you're going to take home office deduction in you're a center, I will definitely encourage to check with a professional just to make sure that you are allowed to get that deduction. Some other things that you can do is paying down debt. If your business has any debts, this could be a good opportunity to pay them down. This will definitely be a tax deduction that you will be able to take, and it can save you money in the long run as well by reducing interest payments. Also, you can create a reserve fund. And we have a question in the chat. What form for family deductions? It's the form 8829. I will write it in the chat. And let me see if I can send the IRS link just so you see it. And this form, essentially, you will attach it to your tax return. And it's a design by the IRS to include those home office expenses. And since you're a home daycare, you have your business in your home, so legally you have the right to claim all your business use of home expenses there. So I just sent the link in the chat for the form 8829, just so you can see it. You can get familiarized with what type of business use of home expenses you can claim. Also, it includes the time space calculation there. That's a whole different topic, but it's included as well in that form 8829. Perfect. So just as I was saying, Some other things that we can do to mitigate taxes is creating a reserve fund. Even though this won't lower your tax bill, sometimes it can be more beneficial to create that extra cushion of cash or reserves instead of doing any other strategy, just because it will definitely give you that additional security for covering for unexpected cost or future expenses. Another thing that you can do is investing in business expansion. With higher profits, you might consider investing in the growth of your business. And we're not necessarily referring to expanding the facilities or making a new space or even expanding capacity. When we say investing in your business, we mean you investing in maybe an upgrade, investing in your staff, investing in any aspect of the business, because those are things that you will be able to deduct from your taxes. Let's say if you buy new supplies, or if you give your staff a bonus, whatever form of investing in your business you can think of, whatever you prefer, that's something that you will be able to deduct. Also, and for some centers or some businesses, this might work, and is deferring income. If it's possible, you might consider deferring some income to the next tax year. This could involve delaying the billing until the beginning of next year. However, this strategy, and I will say, has to be used very, very carefully, because it could increase taxes for next year, or it could cause some um, billing discrepancies that are harder to deal with. So if you're choosing to defer income, right now we're in December, so it's a little bit easier to defer income. Maybe you tell someone to pay you until January or something like that. But still, this has to be used very, very carefully. But definitely an option that some people like. And finally, you could do contributions to charity. If you make contributions to registered charitable organizations, of course, you support the community. You can choose whatever charity that you would like, and you can also deduct that donations from your taxes. So you have a few options in case you will want to save money on taxes. What if my revenue is low or negative? And as we mentioned earlier, sometimes a mid review reveals that taxes aren't actually the biggest issue. Instead, you might discover that your profit is lower than last year, or you may even be on track to lose money. If that's the case, the focus shifts from tax planning to strengthening the financial health of the business. But again, we can only find out if we do a mid-year review, or if we have at least a sense of what's going on in the business. Some practical steps you can take: first, review and reduce expenses. Start by taking a detailed look at where your money is going. Are there costs that can be reduced without lowering the quality? Can you switch to more cost-effective suppliers or services? Are there subscriptions or tools you're paying but not using, or not taking the most value out of them? Can you streamline or share resources to avoid waste? Even small savings will add up over the course of the year, so make sure you are aware of everywhere that you can decrease costs. Also, you could try to improve billing and collection processes, especially for those businesses that have issues with collecting payments. If slow paying families are creating cash flow problems, make sure we have a good collection policy, and it can be hard sometimes, but make sure invoices go out on time. You can try to offer multiple ways to pay, consider late fees or automatic billing, and send reminders before payments are due. Because improving collections will increase cash flow if that's an issue for your business. Another thing you could do is exploring financing options, and I will add carefully here as well, because if the issue maybe is temporary, like a seasonal dip or an unexpected expense, you might consider a short-term business loan, a line of credit, or a small working capital loan. There are a few options. Again, be very, very careful if you decide to go the financing route, because there will be interest involved. There will be terms. Be aware of the prepayment penalties if there are any. Be aware of how much actual interest you're going to end up paying. So be careful with that. Definitely a good option if managed correctly, but we have to plan ahead. Also, evaluating pricing strategy. This is something that I really, really recommend all businesses to do at least once a year. And by this, I don't mean increasing your prices necessarily. I mean just make sure that you are charging what you should be charging. For me, there are three factors or three aspects that we have to consider whenever we are evaluating or pricing. First is making sure your prices on what you're charging is enough to cover your costs. So that's the first thing that you will want to make sure of. Second, you can consider your target market, your demography, your area, and all that. Third, you can consider also competition. How much is everyone else in my area charging? If make sure you remain competitive, make sure you provide the value that you're charging. So as long as you're evaluating pricing strategy constantly to make sure you're getting or maximizing the amount of money, the amount of revenue that you can receive, then you should be on the right track. And I know raising rates or evaluating rates isn't necessarily easy, but it's going to be something we have to do as business owners or as business managers for making sure we're maximizing revenue. Also, we liked always to mention that seeking professional guidance sometimes can be a good thing. Like if you have taken some of these steps and still feel stuck, a financial advisor or even an accountant or a business coach can provide a fresh perspective, can help identifying hidden problems, or maybe they can come up with strategies for increasing revenue, reducing expenses, and the main goal should be always supporting in building long-term financial stability. So sometimes an outside voice will definitely help you see things that you might have missed. So in case you feel stuck, always consider professional guidance. Just to conclude, I want to say that proactive planning for year-end tax savings, it's a crucial process for any business owner. By analyzing your revenue, expenses, and estimated tax payments, you can estimate your profit, your tax obligations, and you can make informed decisions based on what's actually going on in your business. So again, the mid-year review gives you time to make these to take these decisions and to make changes based on those decisions if there are changes to be made. And remember, these are broad strategies. The best approach will depend on the specifics of your business. So it's always a good idea to consult with a tax or financial professional to make sure you're making the best decision considering your unique factors, your specific situation. Of course, I can't look at your numbers right now, so all the decisions should be made based on your specific numbers and your specific factors that are affecting your business. So always make sure to consider that. Like the mitigating tax strategies that I show you, maybe not all of them are applicable to your case, maybe a few of them. So that really depends on your business. I'm here to show you like a general picture. I want you to take what works for you specifically. Of course, you can explore as many options as you want, try what works, what don't work, and go from there. Just to wrap up and a quick reflection before we open up the floor for questions. Well, I want to thank you again for taking the time to join the webinar. And before we close, let's take a moment to review some of the things we have seen, some of the things we have accomplished, and some of the things I want you to take and start implementing. First, uh, I think we kind of got a good idea or a good understanding about the documentation needed to submit an annual return, all the profit documents, revenue expenses, and all that. Also, using last year's return to estimate this year's potential cost and savings. Why? Because it will give you a very good estimate. And finally, we explore some options for mitigating your upcoming taxes. So, we hope this information has been valuable. I want to see if there are any questions. I will be very happy to answer.